So the Fed made its big move this week. Now what? Volatility is still going to be the game here, but you can capitalize on this opportunity. Remember, being a contrarian investor is never out of style, and you want to capitalize on certain dips or oversold situations. Acquire when things go on sale and hold and build your dividend passive income and reinvest it. Grow it. Remember to zig when everyone else is zagging. And this is the strategy that built me, and it's going to build you too. So quickly, this weekend I want to cover 4 deep play value opportunities that I added to this week and think you should consider for yourself as well. The first one being Pfizer, PFE, 5.7% yield on that equity holding there. This has been an interesting play. It's deep value at this point, trading very poorly against its peers. Still appears to be at quite a discount. These are the opportunities that you're looking for to acquire when these are very out of favor. Pfizer, as we all know, a COVID darling, instead of squandering their COVID earnings, they took that money and they bought company after company after company. Now they're seeing some good traction. Even though COVID has faded and gone by the wayside and revenues from those products has dwindled substantially, Pfizer's building that stream back up again with key acquisitions. So you will get paid 5.7% to wait for that turnaround play in Pfizer and let it catch up to its peers. And this is a fantastic opportunity for you going forward. The turnaround is close. Be on board for it. Another opportunity that's on my radar, and I acquired more of this week and should be on yours as well, is CVS. Some people talk about it, some people like it, some people don't. I like it. It's 4.6% dividend yielder, down 27% year to date. They've got some headwinds facing them. There's always something regulatory, but this is a top-notch company with fantastic revenues, solid balance sheet, a dividend grower over time, and it looks like they've got a good plan in place to keep this engine humming along and creating great opportunities for investors like you. I seized the moment in this dividend stock this week and will continue to build up a substantial stake, as I'm a believer in CVS now and into the future. This will be another cornerstone investment to make, and we'll get more into this in the coming videos to show. Archer Daniels Midland is a company you can't be without. In the agricultural space, this is a behemoth and a must-own for all investors that want to invest in this area. Archer Daniels, 3.2% dividend yield, down 27% year to date. Can't say enough about this. They had an accounting issue early in the year. The management team moved swiftly to address that, replacing the old CFO with a new CFO. They addressed problems. They moved forward. This is a perennial dividend grower, folks. And they actually have quite a low payout ratio, so there's a lot of room to raise the dividend going into the future. Again, this is one of those companies that touches everything in your food supply chain, and something you can't be without as this world gets bigger and bigger and has more and more mouths to feed. And after they had the accounting issue, which they resolved earlier in the year, they went ahead and raised the dividend then 10%, which shows the board and management's confidence in the strength of this company going forward. Still selling at fire sale prices, Archer Daniels Midland is something you'll want to take a close look at and continue to build your stake in. The last company I wanted to highlight for you that I began to aggressively acquire recently is ST Microelectronics, a European semiconductor play. Very interesting, down over 40% from highs of just a few months ago. They hit the headwinds that many of the other semiconductors are making. They're in industrial, automotive, and those are tough spaces to compete in right now with slackening demand. However, this has created the exact opportunity for you as the investor to jump on that and capitalize. Again, this is a long-term hold to acquire a substantial position. You'll be glad you got in on this when you look 6 months, a year down the road. This also pays you to wait. At a 1.2% dividend yield, that's nothing to sneeze at. That helps provide income to you to find and invest in more shares of ST Microelectronics and then other companies to build that passive income flow and wait for that great turnaround in this fantastic opportunity. We like our tech companies. This is one of them that's a must-have and should be on your radar screen to consider moving forward. So there you have it. 4 contrarian deep value plays that all pay you something in the form of a dividend to hold and wait. I added to these in my portfolio this week and will continue adding to these in the opportune moments. You should take a look at it as well. Give me your comments below and we can discuss.